Look, thanks, Dave. Thanks very much. Before I open the session up to the floor, just like to tie together a few points from our presentation. As I mentioned at the outset, market conditions were challenging. However, we've traded through well, and our expectation is we'll continue to do so. Our focus remains on the long game, gearing up for the extraordinary years of growth ahead. As investors, you're likely to want to know what we think the difference is that will get us through. We don't take the challenges lightly, we're not complacent, we know there's plenty to worry about, and I've read elsewhere that there are 4 areas that an investor would be interested in. The first would be the purpose of the company. And you know this well. It's exemplary. It's simply to look after older people to the very best standard we possibly can. The second area an investor might be interested in would be the quality of the management. We've got an experienced, dedicated team with strong culture of doing the right thing for our residents and staff across all our villages and at all levels in the company. We continue to focus on adding strength and depth to that team, and this is paying off. The third thing that you might be interested in would be the financial strength of the company. I've already talked about the strength of our underlying profit, but bear in mind that with our terms, and we have the lowest deferred management fee capped at 20% of all the listed retirement village operators, it's 50% lower than some of our rivals. This gives us a significant competitive advantage when market conditions change. That low DMF combined with our fixed fee model, which is fair and residents love, makes moving into a Ryman village a compelling option. 50% of our underlying profit is retained to invest in clinical excellence and enhancing the quality of life for residents. We've been consistently lifting the standards by investing in innovation and technology, and we're getting the best audit results. And finally, the fourth thing that an investor might be interested in would be our potential for growth. Our existing sites are in excellent areas and are in strong demand. We recycle capital effectively, we continuously reinvest in our villages, and we keep them up to date, and they're in demand. As well as a great existing portfolio of 36 villages, we've got a record pipeline of villages in excellent areas to build, and a significant number are already consented. So the reputation and the trust that we've built by caring for thousands of people and their families over 35 years is really important. So I'd now like to open the session up for questions from the floor, and following that we'll take questions from callers who are on the conference call line. We'll bring a microphone around for those of you with a question in the room in order that you can be heard. It's important that the people on the webcast can hear you clearly as well. For those of you listening on the phone conference, the operator will advise you when you can ask a question. So questions, thank you.
First one from me is just on current market dynamics. You've noted some softness. I was wondering if you could provide a bit more colour as to how trends in days to settlement and days to sale and new sale stock have been recently compared to, say, a year ago.
Yeah, so in terms of the days to settle, we haven't actually seen any increase. In fact, it's actually slightly shorter for us in terms of our resale stock, the days to settle on that, than what it was a couple of years back. So the trend hasn't been, well, it's been good on that front. And in terms of the selling, we're still selling well off plans. So we've got record pre-sales for the end of the year at 148 million. So the demand is still strong for our new sales as well.
And if you look at your realised pricing versus the pricing assumption built into CBRE valuations, what sort of premium are you achieving over that assumption currently, and where was that, say, a year ago?
Oh, that's a good question. We're achieving a small sort of premium over the top of that. CBRE obviously look at the data that we've over the last 6 months, and they follow us. Obviously, as the markets flatten out, we have been cautious with our pricing in the last 6 months, but we've continued to achieve good pricing. We haven't had to pull our pricing back. So CBRE have just monitored that and probably closed the gap slightly, but there's still plenty of headroom.
I think, Andrew, one of the big highlights for me when the numbers got pulled together by the team is just seeing cash receipts from customers hitting $1 billion for the first time in the company's history and growing 15%. Now, in really challenging market conditions, that's a tremendous achievement.
And just on you've noted the development profile that you have ahead of you. Just thinking about what that means for your CapEx commitments for the year ahead and the new land purchases that you've also announced, how should we think about a sort of a total CapEx number into the new year?
Yeah, so obviously, like, our investment's going to increase. We don't give guidance on exactly what our CapEx will be, because obviously it will depend on when we get going on those 12 sites. But we have seen a significant lift in our investing cash flows over the last couple of years. We'll continue to see that as we build that momentum. And that's one of the reasons why we've increased our bank facility, to make sure we can maintain plenty of headroom to do that. The bank facility is sufficient to do that in our modelling, and will still maintain appropriate headroom. So,
and just on that point on sort of debt facilities, as you are growing and investing more, and your requirement for debt is that much greater, how are you thinking about having sufficient diversity in your funding group, or sources of funding? Are you looking at introducing a bond, and do you feel that you have sufficient diversity in your banking syndicate?
yes, so obviously we are looking at the bond market. It's something we will continue to consider, but we haven't made any firm plans around that at this stage. But we've brought Bank of China on, so we're diversifying our banking partners and introducing new partners to give us more diversity, and also away from some of the sort of New Zealand, Australian banks as well, to make sure we do have a bit more flexibility in that group.
And just to clarify, how many banks are in the group at the moment?
So 6.
6. Great, that's all from me. That's very helpful, thanks.
Yeah, and we have I think it's fair to say we have quite a different banking relationship with our banks. We're very close with them. We update them on, they really understand what we're doing. We don't, I'm aware that some businesses, I think, treat banks as just the banks, but we treat them as a key business partner of ours, and they're very, very supportive. And so when it's quite a high hurdle to come into the Ryman syndicate, we introduced the first new bank back in about 2009. We've grown it very cautiously and conservatively since then, and it's a very well-established unit, if you like. So it's not a relationship where we sort of play one off against another. It's a good team. It's a good team. Yeah.
Morning, guys. Jeremy Simpson at Forsyth Bar. Just some development questions. The Geelong one, you said you're just waiting for the final sign-off of the plans. When do you think you'll actually be able to be digging?
Well, I hope in the next couple of months.
Okay.
Yeah.
That's good.
Yeah.
And just the Bishop's Park project looks interesting.
Yeah.
How many residents are there? Like, what are the logistics of finding homes for them while you're doing the redevelopment?
Yeah, so when we initially started discussions with the Bishop's Park's residents, when I went out there, 6 months ago probably actually, there was still a care centre in operation, and also probably about 40 retirement village residents. So what we've offered those residents to ensure a really pain-free transition is that, under no obligation to accept it, but we've offered people to be able to move into any of the 6 Ryman Christchurch villages at no extra capital cost, to equivalent type units. And then when we have built the village, assuming we're able to get all the approvals, etc., that they're about to move back as well with no additional capital costs, because I think that's fair. If someone has been there for a number of years and their historic occupancy advance has stayed the same, it's not fair for people to wonder how they might come up with additional capital to deal with an unusual situation. So it was the Anglicans who decided to pull out of doing aged care in the village because it wasn't profitable for them anymore, losing too much money. And we also worked with the care centre residents, again, to offer people to be able to come into any of our aged care centres under the same terms and conditions they were enjoying. So we got a lot of good feedback actually about taking all the financial stress away for people at a really difficult time. And I think there's about 15 people there today, and obviously we still need to get overseas investment approval to fully secure the site, which we expect anytime soon.
Great. And just lastly, what sort of build rate should we be thinking about for this year and next year in terms of beds and units?
Yeah, well, we had a build rate this year of 757. beds and units. So I think something in the region of sort of 850 to 900 would be good.
For this year?
Yeah,
And
maybe
next year as well?
maybe 900, and then for the following year be higher again.
Okay, cool.
Yeah, maybe nudging into the 1,000.
Great, thanks.
Yeah.
Good morning. I'm Stephen Ridgewell, Craig's Investment Partners. Just firstly, a question on the result. It was a strong second half on the development side, particularly margin up to 32% from 27% in the first half. And if I recall correctly, at the interim result, you flagged that you might see a bit of softening of that margin that's gone the other way. So just interested if you could give us a little bit of colour as to what resulted in that better margin in the second half, please.
Yeah, so in Australia, Stephen, the continued strong pricing at Nellie Melba continued with build costs that essentially have matched the end of the Weary Dunlop build back in probably about 2014. So those draws widened. We don't like to count on that, but the market remained in those sort of conditions in the second half, which was really favourable. And also, despite the really difficult Auckland, challenges with the Auckland housing construction market, we're still able to get good pricing for those three Auckland villages coming through, and also construction costs which were not quite as bad as what we thought they'd be. So ended up with good margin across all four.
That's helpful, thank you. And it looks like you've bought some great sites.
Yeah.
Driven past
Yeah.
the Kohimarama
No,
a
they're
number
really
of
good.
times and was wondering who was going to buy that.
Yeah.
You picked it up. But just a broader
really
question on the land banks. You're up to 7,000 units and beds now. I think you've expressed a desire of to get to 4 villages a year in the medium term. So that sort of sounds like about 1,600 units of beds a year. So you're at about 4.5 years land bank now. But noting your comments earlier, Gordon, that look in Australia, perhaps the continuing time frame is a bit longer than expected, probably a little bit in Auckland as well. How many years land bank do you sort of think you need to be able to deliver on that ambition? Is it a 5 or 6 years? Just trying to get a bit of a sense as to where the land bank might be heading in the next couple of years, please.
Yeah. Yeah, so look, I think like in an ideal scenario, Stephen will be in a position in say 2 to 3 years' time where a land bank would reflect that sort of build rate times say 4.5. Yeah.
Okay. Thank you. And just on the comments on there's obviously well publicised wage pressure in the aged care sector, and no doubt the wage increase is well deserved by the staff. But from an investor perspective, is there any offset that you can see in that part of the business in terms of getting economies of scale or other kind of efficiencies in the business to try and offset the wage pressure?
Yeah, look, I think that the reality is that the government cannot continue to underfund aged care in New Zealand so chronically. And so we've taken a decision that it's vital to hold on to our 520 or so registered nurses that we have. What you've seen with other operators is that there's some care centres, Stephen, they've lost all of their nursing staff in the last few months to the DHBs. Now, yes, there's say a $5 million cost in paying people more, but what's the cost of losing all the nurses? I'd say it's arguably more, So, and what's the offset from it? Well, we work very hard with the government together with the Aged Care Association, so there's a good understanding of, I guess, what fair returns should start to look like soon. And when we hear things like in Northland or in Southland or in Nelson, where, for example, dementia care facilities are almost unavailable now, the suppliers got so restrained, that the reality is that something will change in a sector that's chronically underfunded and for which there's significant demand. It just has to.
Stephen, the other comment I'd make is that in terms of productivity, we know that if we've got an engaged group of staff, we'll achieve a 20% increase in productivity and an 80% reduction in staff turnover. So we've told you that staff engagement is at the best level ever. So we're achieving productivity for the investment. Yeah.
Great, thanks for those comments. And then just a broader question on market conditions, which you have touched on, but we have been hearing there's a bit more above the line discounts and offers and that kind of thing in the sector. Note your comments, demand has been strong, you've had a good March, etc. But can you just give us a little bit more colour as to at a village level or within Auckland and Melbourne in particular, how the company's evolving its marketing and offer to incoming residents, or is it more or less
Yep.
steady as she goes.
Yeah, it's steady as she goes. Because we don't want Kevin to turn up and tell us that we're doing something crazy. And look, what that means is that we're just straightforward with people. So we don't sort of deal with someone today and then next week we tell them a different price and people get sort of unsteady and not quite know where you're actually at. And the other thing we don't sort of do is say, well, we've got a year end in March and we've got a half year at the end of September. So we don't offer unique deals to those residents. So, for example, we've seen in the market people offering free weekly fees for 2 years, for example. Now, when that resident moves into their next door neighbour, the first thing they'll talk about is the fact that they're not paying weekly fees for 2 years, but the other person is. And those sort of inequities, I don't think people really appreciate them in terms of people living together and understanding an element of fairness. So we don't sort of chuck down $20,000 things here, weekly fee things there. We offer a really fair deal. 20% DMF, cap for life, fixed weekly fees, pricing that's fair, great range of care, great service. And for people who are looking, we are absolutely up there in the choice that they will make. So we really resist that sort of short-term stuff.
That's great colour, thank you. That's all from me.
Jeremy Kincaid from UBS. Just following on from Stephen's question just then, should we see substantial tightness in the market? If you're not willing to offer, various incentives and the like, what levers are you willing to pull to sort of drive sales should, things tighten?
Well, you always have to do a number of things, really. You've got to have really strong community relations so that the pipeline of people that are interested in strong. You've got to have, you've got to be performing at a village level so that people's word of mouth in the area see you as the place to be. You've got to have happy residents so that that word of mouth spreads, and happy staff who do a good job. You've got to be able to invest in the facilities so that they always look nice. You've got to have the best terms in the sector. You've got to have a care offering which is comprehensive and includes secure dementia level care. And so if you have a really terrific offer, our view is that if you have a really terrific offering what we would see as the best, arguably the best terms in the sector, clinical excellence, service excellence, you've seen the sort of ongoing and relentless pursuit we have of making life for residents better, then that's actually, for us, what drives demand. And so, in a difficult market this year, that's why we've only got 1% resale stock.
That all underpins the affordability graph that David Bennett showed you, which showed you that there is a good gap between real estate, between residential pricing and entering a village or having a service department.
Yeah, I think it's really important that what we talk about the team is, it's really important to trust the process, trust in what we do. And that's the most effective way to ensure demand and a wait list. And I think that people don't really relate to a price with a big line through it saying 50 grand off and that sort of thing. That's quite a different market, I think.
Okay, great. Then my next question is just on the village you purchased in Christchurch. Are you able to give an indication as to whether or not that was at a premium or a discount to NTA?
Well, what it was we assumed the liabilities of the residents. So the capital sums are paid minus the deferred management fees. It's our obligation to pay those people out in due course when that happens. And that was it.
Okay, great. And then just also at your other site in Victoria, the sales appear to be going strong there. Are you able to give an indication of what the price point is there for that village and then where that sits relative to the surrounding villages?
Yeah. Well, Dave, do you want to deal with that?
Is that Nellie Melba?
Yes, Nellie Melba.
Yes. So that is that chart that we showed. That is pretty much that the difference. So obviously Nellie Melba and Weary Dunlop in the same sort of geographical area, same market, and similar pricing because different offerings for what people look for. So we're at about a 25% discount to the surrounding market there. The market has pulled back over the last 6 months, but we've been able to maintain our pricing because of the buffer we've had there.
Okay, great. And then very lastly from me, David, your bank facility's obviously gone to 1.7 million. Does that imply to the market that your modelling doesn't suggest that bank debt tracks above that level over the sort of foreseeable future?
That's correct.
Correct.
Fantastic, thanks.
Yeah. It's quite an interesting conundrum for people if they move into Nellie Melba and they've sold their house for, say, 400,000 above, you know, able to collect that 400, they've freed up, say, $400,000 of capital. Because often for people in life, you know, the house is their most major asset. And so again, that grand opening night, quite a few people quietly said to me, what do you do with 400 grand? And because it's a quality problem that a lot of people have never had. And of course, if someone moved into a service department, you're looking at sort of freeing up 700,000. So it's a great way for people to free up equity and downsize, and it really sort of shows through in that market.
They're largely 80 years of age and more, you know, mortgage-free, so they are going to free up significant sums of money. Other questions? Shall we just see if there are questions on the line? Thank you.
One question.
Sometimes there's a need just to pause for people to unmute.
Telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you are on a speakerphone, please pick up the handset to ask your question. Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. Your first question comes from Mayor Candlewell from Candlewell and Company. Please go ahead.
Thank you. So I had a couple of questions, primarily on Australia. First was the Geelong project. I know that there was some pushback in the community, and has that pushback experience impacted your evaluation for the 900 build rate?
Yeah, I can deal with that question now. So the question was, there was some pushback in the local community about Geelong, and has that affected our, I guess, our build rate that will result from the village? Yep, so what happened was the team and myself were at a hearing just before Christmas at the Geelong City Council. The councillors at that point get a chance to vote in favour of the application or not. They chose to defer the decision to a thing called VCAT, which is the equivalent in New Zealand of the Environment Court, I guess. So then what happened is that we, the objecting residents and us, had the opportunity to have a mediated session through VCAT about 5 weeks ago, I suppose, and that outcome was successful. So what we did was we moved townhouses about 5 metres, I think it was, back from the western boundary, and we also removed about 6 townhouses from the scheme. That created a greater sense of space between the neighbours who were particularly affected, and it also created some more space in the village and didn't affect our feasibility materially. So it was a really good outcome because the community was really happy that we had listened to their concerns. Nevertheless, we did go into that mediation with a fully supportive decision from the Geelong Council in terms of the development complying with every single requirement for the development overlay. The purpose of the VCAT meeting was really to see if resident concerns could be mediated before a formal tribunal, and that outcome was really successful.
Okay, and has that changed your approach to Australia development at all, or are you more concerned that development may be slow in Australia, or do you believe that you've learned and you can move more rapidly now?
No, we've actually assumed for some time that the majority of development approval processes may somehow go through VCAT. it's a very, very common process in Victoria, more common than not. And so it's great to have gone through our first process, which actually I thought was quite quick. You know, the decision was turned down right at the end of December, and we had an answer pretty much by the end of April, fully sorted. So that was quite good. What the real lesson learnt from it was that I would have liked to have got the development application in probably 6 months earlier, as a lesson learnt internally, because we can control that. And obviously we're just keen to keep our position of talking with neighbours and understanding their concerns and perhaps trying to address that as soon as we can, you know, earlier on, if that makes sense.
Okay. And then along the Australia theme, is there a thought of listing in Australia? Right now, I guess, you know, on the horizon, about 10% of your properties will be, better than 10% will be in Australia, right, at some point in time. You have a reputation with the community there as a place for the elders. It would also be natural then to put the capital to work there as well.
Yeah. So is the question whether we're considering listing in ASX? Yeah.
That's right.
Sorry, I just missed the first bit. Okay, so the question is, are we thinking of listing on ASX? We're doing absolutely no work on that at this point in time. It's not under active consideration. It has been in the past, but we've decided not to do it for various reasons, one of which being that we're getting excellent access to international investors through Europe, America, Asia, all over the world, including Australia. And so we're just wondering what the value of an ASX listing is actually, particularly as the New Zealand market cap that we have is not recognised in Australia except for the Australian traded component. So, and the other sort of slight irritant is that the listing fees are huge, and they won't cut a deal. So anyway, so with ASX, I think we'll just leave that for the time being. It wouldn't rule out other exchanges outside of Australia.
Okay. All right. Thank you.
Thank you. There are no further questions at this time. I'll now hand back to Dr. Kerr.
For joining us. Let's have an informal discussion over a cup of tea and a sandwich, and we'll look forward to a more formal briefing at the time of the AGM. So thank you very much.